You ever look at a company and just wonder, what's really going on under the hood? Past all the flashy products and the slick marketing, how do you know if it's actually healthy? Well, it turns out there's a universal language for that, and it's called financial accounting. So let's kick things off with the big question.
This is really the fundamental question, isn't it? Whether you're thinking about buying some stock, or maybe lending a company money, or even just taking a job there, you're basically placing a bet on that company's future. So the real trick is, how do you make sure that's an educated bet? Where do you find the solid info you need to make that call?
And here it is, the official answer. The whole point of all those, thick annual reports and crazy complex spreadsheets, it's all to give people like you and me, useful, standardized information so we can make smarter economic decisions. It's not just about crunching numbers, not at all. It's about making informed choices.
Okay, so if these reports are basically a language, a way to communicate, then who's the audience? Who's actually sitting down and reading these things?
Well, you can pretty much split the audience into two big groups. First, you've got your external users. Think of them as the outsiders looking in, trying to figure out if they want to do business with the company. And then you have the internal users. These are the folks inside the company using that same data to, steer the ship and make day-to-day operational decisions.
So let's get a little more specific about those external users. We're talking about investors, right? They want to know if they're going to get a return on their cash. Then you have creditors, like banks, who are asking, can this company actually pay us back? You've also got financial advisors, stock exchanges, even regulatory agencies making sure everyone's playing by the rules. It is a really wide and varied crowd.
Okay, now think about this. For any language to work, especially one involving money, everyone has to be playing by the same rules. You can't just make up your own definitions, right? It would be chaos. So let's talk about the rules of the game.
Right. So in the United States, that official rulebook is called GAAP, which stands for Generally Accepted Accounting Principles. Just think of it as the official grammar and vocabulary for the language of business. GAAP is what makes sure that when Company A reports its revenue, it's measuring it the same way as Company B. That makes them comparable and, reliable. Without these common rules, you get total chaos. That's why those big historical scandals were so damaging. Companies were basically inventing their own accounting, and it totally misled investors. GAAP is the system that's designed to make sure everyone is telling the same kind of story with their numbers.
And one of the most fundamental rules in that book is something called the going concern assumption. What does that mean? Well, it basically means we assume the business is going to keep on operating for the foreseeable future. We're not pricing things as if there's a giant going out of business sale tomorrow. This whole idea is what lets us take a stable, long-term view of the company's financial health.
All right, now for a really, really crucial rule. This one's all about timing. GAAP requires something called the accrual basis of accounting. And the core idea here is actually pretty simple, but it is so powerful. You record financial stuff when it happens, not necessarily when the cash actually changes hands.
So let's break that down. Under the accrual basis, let's say you sell something in December. You record that revenue right then and there in December. It doesn't matter if the customer doesn't actually pay you until February. See? This gives you a way more accurate picture of how your business did in December compared to the cash basis, which would just ignore the sale until the money showed up. It's all about matching the effort with the reward in the right time period.
Okay, so we've talked about who's reading the reports, and we've talked about the rules everyone has to follow, but what are they actually reading? What documents make up this whole financial story?
A full, complete set of financial statements has these 5 core parts. A great way to think about it is this. The balance sheet is like a financial snapshot. It tells you what a company owns and what it owes on one single day. The income statement, on the other hand, is more like a movie. It shows you whether the company made or lost money over a whole period of time. The other statements fill in the gaps, tracking the owner's stake and, so important, following where the actual cash went. You put them all together, and that's when you get the complete picture.
But wait, it's not just about those big headline numbers. At the end of the reports, there's a whole section of notes. And I'm telling you, this is often where the real story is. These notes are considered a core part of the statements. Seriously, all the juicy details and important explanations live here. This is not optional reading, folks. It's absolutely essential.
And look, if you really want to understand a company, you have to read the notes. The very first one is usually the most important. Why? Because it tells you exactly how the company chose to apply all those GAAP rules we talked about. It's kind of like in math class, when the teacher tells you to show your work.
This is the company showing you its work, explaining the exact methods it used to get to its final numbers.
All right, time for the final piece of the puzzle. So, we've got these 5 different statements, plus a whole bunch of notes. I know it can seem like a lot, but here's the crucial thing to remember. They aren't separate, standalone documents. They are all deeply interconnected. Let's take a look at how all these pieces actually fit together.
And this, right here, is the key. You have to think of each statement as telling a different part of the exact same story. A single transaction, like one big sale, can leave its fingerprints on multiple statements. So you can't just look at the income statement and think you've got it all figured out. No way. You have to see how it connects to the balance sheet and the cash flow statement to really get the full story.
Here are a couple of great examples of how this works. So, the profit a company makes, that's net income on the income statement, it doesn't just disappear into thin air. No, it flows right over into the retained earnings part of the balance sheet. Or, how about this? The amount of inventory a company has at the end of the year, that's on the balance sheet, is a key number used to figure out a major expense on the income statement. It's this beautiful interlocking system where everything affects everything else. All right, we have covered a ton of ground here. Who reads this stuff, the rules they follow, the reports themselves, and how they all connect. So let's bring it all home. A quick pop quiz to see what stuck. What is the main goal of, well, all of this?
And the answer is D. See? It all comes back to that one simple goal from the very beginning. Every single rule, every report, every number, it's all there for one reason: to help people make better, more informed economic decisions. So at the end of the day, financial accounting isn't just about math. It's about storytelling. It's the language that businesses use to tell us about their performance, their health, and their potential. And now that you know the basic grammar of that language, the only question left is, what stories are you going to find hidden in the numbers?